The port of Corpus Christi, once a bustling hub of tankers, engines, and energy deals, has fallen eerily quiet. No lines of ships waiting to load, no engines revving with purpose, no deals closing behind the scenes. As of mid-2025, something unthinkable happened. U.S. oil exports to China disappeared. Not reduced, not slowed, vanished. There was no embargo, no fiery press release, just a subtle, strategic 10% tariff. And then silence. From 160,000 barrels a day to almost nothing. America's biggest export play, shipping crude oil to China, was suddenly irrelevant. And it happened without warning. At the very moment President Trump was celebrating energy dominance as a reality, China had already stopped answering the call. The U.S. had spent nearly a decade building ports, pipelines, and infrastructure for the world's hungriest oil customer. Now those same pipelines trickle, storage tanks are full, not from a glut of supply, but from a collapse in demand. And the biggest buyer on the planet has moved on. In Washington, the administration focused on wind turbines and domestic gripes, while Beijing rewrote the rules of the energy world. Not in dollars, but in yuan. A strategic shift, not an accident. By April 2025, China had quietly locked in long-term oil supply contracts with Russia, Iran, the UAE, and Saudi Arabia. Bloomberg reports confirm that most of these contracts were denominated in yuan, not dollars. Not a single agreement routed through U.S. banking infrastructure. This wasn't a case of diversification. This was extraction. China surgically removed American oil from its system. The painful irony? The U.S. helped build the very export infrastructure that now sits idle. Between 2015 and 2023, over $25 billion was invested into upgrading Gulf Coast ports, deepening harbors, expanding terminals, all designed with China in mind. The logic was sound. America would supply oil to the fastest-growing market on Earth. But by 2025, that entire bet had collapsed. China didn't wait. It rewired the system. Chinese refiners didn't wait for policy clarity or negotiations. They simply stopped booking U.S. oil cargo. Even steep discounts couldn't win them back. By May, Reuters confirmed that U.S. oil, even at bargain prices, was still being passed over. Not because of supply issues, but because China had already restructured its entire import system. Refineries had been re-optimized for Russian and Middle Eastern blends. Payment networks were redesigned to support yuan, and shipping routes had been anchored to suppliers beyond Washington's influence. And what was the U.S. government's response? Instead of addressing the oil collapse, the administration launched trade complaints, blaming Canada for lumber prices and threatening new tariffs on Mexico. This wasn't sabotage. It was a strategic surrender. The silence from China wasn't accidental. It was strategic and permanent. India soon followed. By July, New Delhi had signed expanded agreements with Russia's Rosneft and Saudi Aramco, again, backed by UN settlements. Southeast Asian nations, including Thailand, Malaysia, and Indonesia, began shifting their payment systems away from the dollar. Even Vietnam, a U.S. ally, adjusted long-term contracts to mirror China's blueprint. No tanks, no treaties, just contracts, just spreadsheets. The battlefield wasn't physical, it was digital. Excel sheets and payment rails. By the way, if you enjoy staying updated with what's happening around the world, don't forget to like this video and subscribe so you never miss the latest global headlines. Export infrastructure. Now a ghost town. By June, Gulf Coast tank farms were operating at under 60% utilization. Corpus Christi, once hailed as the jewel of America's energy exports, saw daily flows drop below 1 million barrels, less than a third of capacity. That's not a slowdown. That's abandonment. Yet U.S. officials claimed this proves we don't need China. The contradiction is jarring. The entire export model was built on China. When tariffs on aluminum were suddenly reversed, it wasn't a sign of strength. It was a quiet admission. America had lost leverage. According to Financial Times, Canada and Mexico now move over $120 billion in trade annually through non-U.S. ports, avoiding U.S. territory altogether. The reason? Stability. Washington's version of leverage had become a code word for unpredictability. Oil isn't just product, it's power, and power is currency. By mid-2025, over 80% of China's oil imports were no longer settled in dollars. Every excluded dollar is one less drop in the U.S. financial system. One less tool for sanctions, one less mechanism of control. Iran noticed. Chinese purchases of Iranian crude surged past 1.7 million barrels per day, 10 times what the U.S. once exported to China. Much of it moved through the shadow fleet, tankers with fake flags, shell companies, and gray market paperwork. U.S. sanctions became a suggestion rather than a barrier. Even with tightened restrictions in early 2025, Wall Street Journal analysis found that at least 40% of Iranian oil exports couldn't be tracked. The fall of the freedom molecule. What once made U.S. oil attractive, price, scale, freedom molecule branding, had been replaced by something more powerful: reliability and independence from U.S. politics. And Saudi Arabia? Riyadh not only allowed yuan-based settlements, but invested directly into Chinese refining infrastructure. That's not a deal, that's a marriage. By July, China's strategic petroleum reserve exceeded the 3-month threshold, meeting IEA guidelines. Suppliers: Russia, Iran, UAE, Saudi Arabia. Payments, not in dollars. A firewall against America. This wasn't just economic evolution, it was a geopolitical firewall. China now has an energy architecture that doesn't require SWIFT, U.S. banks, or even U.S. diplomacy. The U.S. warned the world about energy dependence, then weaponized its financial system, and the world walked away. India joined the shift, using rupee-yuan swaps to buy oil without touching Western banking systems. Even European refiners, still purchasing U.S. crude, began requesting extended payment terms or non-dollar options. Losing more than a customer, losing the market. The U.S. didn't just lose China as a buyer, it lost oil's last monopoly, the ability to price, punish, and persuade through currency. Canada quietly shifted exports to Asia. By July, Canadian crude through U.S. ports had dropped 40% year over year. The cause? Tariff tantrums and unpredictable policy shifts from Washington. By August 2025, the data confirmed the ghosting. China's customs data showed 0 U.S. oil tankers processed in the entire month. Not a single barrel. Not a glitch. A confirmation. S&P Global reported that even backup orders from private refiners, the so-called teapots, had vanished. Not because U.S. oil was bad, because it was now unworkable. China's Bank of Communications launched direct WAN-based energy settlement protocols with Iran and the UAE. Saudi Aramco even began building yuan clearinghouses in Shanghai, not terminals, infrastructure to institutionalize a new currency system. The game didn't change. America just isn't in it. The U.S. isn't being isolated. It's being ignored. The rules it helped to build are still in play. It's just no longer a necessary player. This isn't a confrontation. It's a calculation. And Washington, for all its tough talk, wasn't even in the room when the decisions were made. Final thought, the market didn't move away from America. It simply evolved without it. And when the world stops calling, that's not a negotiation tactic. It's the new normal. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way.